All right, today we're cracking open the playbook of a true Wall Street legend, Peter Lynch. Now, this is a guy who achieved results that most professionals can only dream of. But his secret? It wasn't some complicated algorithm or insider information. Nope. It was a strategy so simple he insisted that you, me, anyone could use it. Let's get into it.
Okay, first things first, you have to appreciate this number, 29.2%. That was Peter Lynch's average annual return for 13 straight years managing the Fidelity Magellan Fund. To put that in perspective, he took a fund with about $18 million and grew it into a $14 billion giant. It's just one of the greatest track records in the history of investing.
So the big question is, how on earth did he pull that off? How did he get these world-class results while championing a philosophy for the everyday person? Well, the secret is surprisingly simple, and it actually starts right where you are, right now. And this right here is the core of it all. Lynch was absolutely convinced that your biggest advantage as an investor isn't some fancy Wall Street report. It's your own life. It's your experience as a shopper, as an employee, or just, as a person living in your community. This single idea is the foundation for his entire playbook. This brings us to the first and probably the most famous part of his strategy, and it's this simple phrase, invest in what you know. Now, this isn't just a catchy slogan. It's a powerful approach that basically flips the whole traditional investment model upside down. Lynch was totally convinced that regular people can spot incredible companies in their day-to-day lives, often way before they ever pop up on Wall Street's radar. He called this local knowledge, and he believed it was your secret weapon, your superpower. You're seeing the story unfold right there on the ground floor. And look, these examples prove his point perfectly. He invested in Dunkin' Donuts because he was a customer. He loved the coffee and he couldn't help but notice the stores were always packed. The idea to invest in Hanes? That came from his wife who told him how great their legs pantyhose were. He even saw a huge opportunity in Chrysler when pretty much everyone else saw a company about to go bust. See, the ideas came from real life, not from watching a stock ticker. So it really breaks down into a simple three-step process anyone can use. First, you just observe. You notice a product or a service that you love, and you see it getting more popular. But, and this is critical, an idea is just the starting line. Step 2 is research. You have to do your homework. Is the company actually financially healthy? Is it growing? And only then, if the story and the numbers both check out, do you move to step 3 and consider investing. Okay, so you found a really promising idea in your daily life. What's next? Well, this is where Peter Lynch's practical toolkit comes into play. These are the tools that help you analyze that idea and really understand what it is you're thinking about buying. Lynch believed that not all stocks are created equal, so he sorted them into 6 different categories. And this isn't just about being organized, it's about managing your expectations. For instance, you buy a slow grower, like a big utility company, for its steady dividends. But if you're hunting for a 10-bagger, that's a stock that goes up 10 times in value, you'd look in the fast growers category. Knowing a company's category tells you what its role could be in your portfolio. Now, at the very heart of his toolkit is this strategy called growth at a reasonable price, or GARP for short. It's genius, really. It tackles that classic investor problem. It's awesome to find a company that's growing like crazy, but how do you make sure you don't overpay for it? GARP is all about finding that perfect sweet spot. You can think about it like this. A pure growth investor is always asking, how fast can this thing grow? A pure value investor asks, how cheap is it? But the GARP investor, the Peter Lynch investor, asks the most important question of all. Is the growth I'm getting actually worth the price I'm paying? It's just a balanced, common-sense approach. So how do you actually answer that question? Well, Lynch had a favorite little tool for that, a simple metric he helped make famous, the price-to-earnings growth ratio, or just the PEG ratio. And here was his simple rule of thumb. A PEG ratio of 1, or even lower, was a great signal. It suggested a company's stock price might be reasonable, or maybe even a bargain, compared to its growth prospects. It's a fantastic, quick way to check if you're paying a fair price for all that growth you found. But you know what? Even with the best tools in the world, they're pretty much useless if you don't have the right mindset. And that brings us to the final and maybe the most important part of the playbook, mastering the psychology of investing. This is one of Lynch's most legendary quotes, and it really gets to the heart of his focus. He thought trying to predict recessions or what the market was going to do next was a complete waste of time. Instead, he said you should pour all that energy into one thing, understanding the companies you actually own. He also pointed out that our biggest enemy is often staring back at us in the mirror. People tend to panic and sell their best companies, what he called their flowers, at the first sign of trouble. Meanwhile, they'll hold on to their losing stocks, the weeds, just hoping they'll bounce back. Patience and keeping your emotions in check are absolutely essential.
To help with that discipline, Lynch laid out some really clear red flags. He said to be super wary of the hot stock in the hot industry. He also warned against companies that start branching out into businesses they know nothing about. He had a great name for it, diworseification. It's like your favorite local restaurant suddenly deciding to get into crypto. These are the classic traps you gotta avoid.
So let's bring it all home. How do we take this philosophy, these tools, and this mindset, and turn it into a concrete plan? Let's boil everything down into your own personal Peter Lynch playbook.
Here it is. This is what it all comes down to. 1. Start with what you know. Your everyday life is your best idea generator. 2. Do your homework. An idea is just a beginning. 3. Categorize your stocks so you know what you're buying. 4. Look for that GARP sweet spot, using the PEG ratio as your guide. 5. Think long-term. Ignore the noise. And finally, 6. Know when to sell. And you sell when the company's fundamental story has changed for the worse, not because the stock market had a bad day.
And that brings us to the final thought I want to leave you with. Peter Lynch absolutely loved boring companies, mostly because Wall Street tended to ignore them. So as you go about your week, just look around. What's that one boring product or service you use that just works? The one people keep coming back to? Because according to Peter Lynch, that might be exactly where your next great investment idea is hiding.